could trip up the EV revolution?
What could trip it up is it needs lithium, nickel, cobalt. You can manufacture the cars, but if you can't get the raw material components, you could be in trouble.
This would be battery metals, lithium, nickel, cobalt.
Prices of lithium battery materials are rising fast. Headlines talk of shortages, reliance on China, and the need for localized sources of secure, sustainable supply. Will auto and battery manufacturers vertically integrate to mine and process their battery materials as Ford did in the 1930s? RK Equity focuses exclusively on critical minerals projects in support of EV and battery producers in North America and Europe.
In this series, we will be looking into several development companies who seek to address the risk and opportunity identified by Byron Wien and Chamath Palapatiya. These videos are based on several independent research notes which you can access on rkequity.com and is for information purposes only and not investment advice. This is Equity Overview with Rodney Hooper.
Welcome to Rockstock Channel and our ongoing equity overview series focusing on individual critical raw materials companies that we think should benefit from the rising demand from electric vehicles, energy storage, and other clean energy technologies. In today's episode, Rodney will present an overview of European Metals Holdings, a company Rodney and I and RK Equity have been advisors to and have had equity interests in since 2020. We should note that we have not been paid to prepare this video, and all Rodney's comments are his own independent opinions. Rodney and I are not financial advisors nor broker-dealers. This video is for information purposes only and should not be considered investment or financial advice. Please do your own independent research, read the disclaimer at the end of this video or on RK Equity's website. Before Rodney makes his European metals comments, I'll make a few of my own. Before starting RK Equity 20 years ago, I spent my 20s during the 1990s immersed in Central and Eastern Europe. After the Berlin Wall fell during my senior year in college, I started my career as an analyst focused on M&A and privatizations in the emerging region, worked at an investment bank in Budapest, and then, after business school, I promoted stocks from the equity sales desk at a French bank. I married a Hungarian, and pre-COVID, I visited the country nearly every year for the past 25 years. In the late 1990s, I largely missed the internet bubble, busy instead talking up the prospects of post-Cold War entities like the Czech Republic's main utility ČEZ. ČEZ, like SQM and many other companies in countries emerging from socialist ideology during that time, IPO'd. 20 years later, when ČEZ wrote a $32 million check for 51% of the Cinovec project controlled by European Metals Holdings at the height of COVID and the bottom of the lithium market, I understood the implications. It reminded me of Lithium America selling 50% of its Argentina asset for just $25 million to SQM in 2016. As an advisor to Lithium Americas at the time, our narrative was not how little LAC sold that half share, but how much value the other half was worth to LAC, given the substantial project de-risking brought about through a strong financial and technical partner and a robust joint venture shareholders agreement. ČEZ, an arm of the Czech Republic, is 70% state-owned. The company and the country has made aggressive moves to transition from its coal mining and coal-fired electricity generation. ČEZ is one of the leading providers of wind energy across Europe and has a big solar business as well. The new Czech government last week made a commitment to ending coal production by 2030. The crown jewel in the former Soviet Union auto sector was the Czech Republic's Škoda, bought by Volkswagen in the 1990s. It is now a very successful brand for Volkswagen throughout Western and Central Europe. In its Power Day last year, VW suggested Central Europe as one of the locations for its 6 planned 40 gigawatt-hour battery plants in Europe. The Czech Republic is aggressively seeking to attract one or more battery plants for which ČEZ will be the most likely state entity any company wishing to build a plant will partner with. News reports and rumors throughout last year mentioned VW and LG, among others, for prospective battery partnerships. ČEZ should be considered amongst the other well-capitalized new entrants to lithium in recent years, similar to Westfarmers buying Kidman, or Sibanye-Stillwater JVing with Ioneer, or China's Tsingshan partnering with France's Eramet. Should Czech partner in batteries alongside lithium production, it would represent precisely the type of vertical integration Rodney and I have been arguing for years is necessary in the industry. Rio Tinto's Jadar project in Serbia has grabbed substantial headlines of late. Thousands of protesters, including, no joke, the world #1 tennis player, which has resulted last week in the government announcing the cancellation of the project's mining permits. In a recent presentation, Rio suggested the world needs 60 Jadars by 2050 for a net zero world. Jadar was slated to produce 58,000 tons per annum. Depending on whether EMH produces 30 or 50,000 tons per annum, the world would need 75 to 125 Cinovec. The Czech Republic just completed in October its presidential election, in which a center-right candidate ultimately won a close election. It took several months to form a government, but with a pro-business coalition now in place, I expect momentum of talks on batteries and lithium to be front and center in the first half of 2022. The Cinovec project is a brownfield, past-producing tin and tungsten mine site. It is in a relatively remote, sparsely populated area of the Czech Republic bordering Germany. It is just 500 kilometers from Tesla's Brandenburg factory and many other emerging battery and cathode plants in the region.
Lithium is the irreplaceable element in a lithium-ion battery. To reach their EV sales, ambitious OEMs need new supplies urgently. RK Equity believes that advanced lithium projects in mature jurisdictions have to some degree been overlooked in 2021 and are likely to come back in favor in 2022, especially projects that could be put into production before 2025. We believe European Metals fits in that category. European Metals trades on the ASX and London's AIM market, ticker EMH, as well as on the OTC in the US, ticker EMHLF. The market cap is about $200 million US, ranking at number 27 on the RK Equity scoreboard as at the end of December. EMH's only asset is its 49% owned Cinovec project, Europe's largest hard rock lithium resource, strategically located to supply the world's fastest growing EV market. An updated pre-feasibility study, a PFS for the project, was published last week and focused on roughly 29,400 tons of lithium hydroxide production at around $5,567 a ton of OPEX after byproduct credits. Post-tax NPV is around 1.9 billion US and a post-tax IRR of 36% over a 25-year mine life. A definitive feasibility study, a DFS, is expected to follow later this year, alongside full project funding, strategic partnering, and a potential start of construction. Cinovec is controlled by the joint venture company Geomet, which is owned 49% by EMH and 51% by Czech. Czech is the 7th largest EU power utility by customers and 10th biggest by market cap, around 13 billion US. EMH is led by founder and executive chairman Keith Coughlin, who has 30 years of experience in stockbroking and fund management. The DFS is currently being undertaken by SMS from Germany, a 3 billion blue chip engineering group. SMS is focused on completing all aspects of the front-end engineering design. Upon DFS, permitting and full project funding, EMS will have to fund its half share of the project. I estimate around 115 million US equity needed. Toward that end, EMH raised equity capital over the past 12 months, principally with 2 institutional investors, Thematica in Switzerland last year and Elliston Capital in Sydney last week. The Cinovec lithium deposit is a hard rock mica Zinnwald mine, rich in lithium, tin, and tungsten. Production is anticipated to commence around 2025. EMH recently commissioned a study which confirmed that Cinovec has the potential to be the lowest overall environmental impact compared to other conventional lithium battery metals projects, not assuming they implement the changes to their 2019 PFS, including using renewable energy rather than coal. Czech is one of Europe's largest solar energy providers. The solar it would provide to the project would most likely be at Czech's cost. This is not a cost EMH would bear, as other projects would, seeking to decarbonize their mining and processing. Cinovec is designing the mine to use electric mining equipment to further reduce the CO2 footprint. By backfilling the tailings rather than dry stacking, the project will have a far smaller environmental impact. Backfilling also enables much more resource to come out of the ground. Completion of the DFS with the SMS Group, secure the necessary Czech permitting, an agreement with one or more downstream customer, be it a cathode battery cell manufacturer or OEM, secure project funding, which could include soft loans and EU grants from entities like the European Investment Bank, such as those provided to Northvolt, Umicore, and LG in neighboring countries. We estimate EMH's fair value at somewhere between Aussie dollars 291 and 349 a share. And even at the top of that valuation range, EMH would have a price to NPV of less than 0.5. So that's an undemanding ratio when compared to its peers and given the scarcity value of European lithium projects. Longer term, we believe an EV/EBITDA multiple is a more appropriate valuation method. Once steady state production is achieved from 2025 onwards, assuming a conservative 10 times EV/EBITDA multiple, we estimate EMH's fair value around Aussie dollar 4.67 a share. If the company is able to expand production beyond the 29,400 up to 50,000, by 2028, our blue sky valuation would go up to Aussie dollars 764 a share.